Hey, good afternoon. This is Trader Tim from EminiMind.com, here to help you improve your trading each and every week. One of the things I want to talk about today is how to muster up the courage to buy the dip. And before we get into today's really great 15-minute breakout trade, I wanted to touch on some of the bigger picture daily chart and that concept of buying the dip. And so while most of you are probably actively day trading, you probably also have a longer term account of some sort, or a 401k, or multiple retirement accounts, Roth accounts, traditional IRAs, that sort of thing. And if you are building a long-term position, or working a job such that you can build a large portfolio of stocks, then you're probably looking at opportunities to buy and being a little bit strategic with your buying opportunities. And so one of the things that's difficult for folks to do is kind of be buying when a lot of the media or the large um, momentum, broader market momentum is moving down. And so I think the number one thing that you want to remember is that if you go back 100 years, the stock market has gone up. And so Peter Lynch would say, if you believe in the company that you're buying, then any pullback is a great time to buy. If you like the company at $50 and its valuation, or its future growth is staying the same, and it's now $40, it's a better buy. So there's a couple of ways you can go about doing your purchases and being just after the new year. A lot of folks are kind of either readjusting their portfolios, or as you've probably noticed in the crypto space, selling after the new year. And one of the reasons we've probably, or a contributing factor in the crypto sell-off, is likely due to folks cashing in on their crypto and then avoiding having to pay that capital gains tax on 21. They'll have an extra year to pay in 2022. So a lot of times you see a sell-off going into, or just after the new year. And so one of the things that you can do is simply, you know, set up a reoccurring transfer, as you probably have if you have a 401k or some sort of retirement account, or a SEP if you're, self-employed. And so if you have, weekly or monthly funds going into your account, you could simply buy more of, whatever fund you're using. For me, I like to use the Vanguard VUG, and just buying up as much as I can over the years. And so basically every pullback is an opportunity to add to the fund. So if you're doing true dollar cost averaging, then you're basically buying as many shares as you have the cash to do so. So if you put in um, $500 each week and it's trading at 300, well, you could afford to buy one share that week, and so you just buy it as soon as you have the capital in your account. A little bit more um, strategic way to go about that um, dollar cost averaging. I guess you backing up, doing that, putting in, purchasing the fund immediately is what we think of as dollar cost averaging. But in real terms, having a pile of cash, let's say you put in $5,000 into your account, and buying up, $1,000 worth over, let's say, 5 weeks would be, you know, the real version of dollar cost averaging, where you have this pool of cash and you're averaging in, versus you're spending all of your funds at once. You're spending, you put in $307 and you buy one share immediately. So kind of had that backwards at the start of the explanation. But what I like to do, and what's really important to be able to have the courage to buy the dip, and not just be buying at highs, selling at lows, panicking, selling at the bottom, watching the market go up as you're sitting on the sidelines. You need to have some sort of a formula. So what you want to do is when the market does pull back, you need to know what am I looking for in order to buy. And it could be as simple as drawing a trend line and saying every time we come down and touch the trend line, I'm going to buy. And so it's just, come down the trend line, you buy. You rally, you pull back to the trend line, and you buy. It could be something along the lines of buying on a certain candle pattern, like a hammer, like we've had the last couple of weeks on these dips. One of the things I like to do is buy when we have a gap up after a move down. So that would be like here. Buying at the open when we gap up following a move down. You could wait for a uh, break of a swing high and a pullback. So here you have a move higher, you pull back, and then buying above the high of that pullback. So just having some sort of formula or strategy for getting in makes it a lot easier because when the market's going down, you know what you're looking for and it's very clear. You could also do things like, okay, I'm going to buy every time the market pulls back 5%, in which case you're going to be, piling up cash, and then market gets a little bit bigger pullback, and then you make a bigger buy at that point. So at the end of the day, you know, all of these methods are great, and so it's just a matter of picking something and sticking with it over the long run. If you say, I'm only going to buy every time we make a 20% correction, you could go a long ways or a long while with just a whole bunch of cash sitting on the sidelines. So I'm more of a proponent of getting that money working for you quicker. And if you end up buying and then taking a little heat on that chunk, not a big deal. Because over the long run, you're collecting dividends, market's going up, pulling back, going up again, and so if you get a bigger correction in the mix, it's you're just averaging those purchases when the market is down, and you end up doing just fine. So we, on the ES here on the weekly chart, we really have not come close to breaking trend from going back to I guess 2 years ago now, 2020, year and 13 months ago, you could say, just connecting some of these lows. And so, yes, we've got some, potential longer term selling potential in the tech sector with the potential strong potential for rise of interest rates. But by and large, things are looking just fine. And if we go over to the NASDAQ, if we come down and start breaking some of these more major weekly swing lows, that's when I would be watching for some sort of larger pullback. But at this point, there's still we've so like on the S&P, for example, 5% off of highs is a 45.78, and so that would be basically right down here at lows of the day. 45.82 is where we went. So I mean, didn't even make it 5% off of highs. So just kind of keeps things in perspective when you go out to a weekly chart and you look at the bigger picture. If you're only waiting for a pandemic sell-off to add to your long-term position, you could be waiting for a long time. So having some sort of approach to buy the dip on all of these pullbacks and get that money working for you, collecting dividends, compound interest, really does a lot, especially if you're adding little chunks every single week or every single month. So let's switch gears here and talk about the intraday ES trading. Most of the first week of the year tends to be kind of carryover from the end of the year, in that I like to not do a whole lot of trading the first week. And so last 2 weeks of the year, first week of the new year, good time to just kind of sit back and observe. And what we had today is a gap down, and we had a really nice 15-minute breakdown where we broke below the first 15-minute bar, and then we sold off for a good 30 minutes or so before we saw this little green bar. And so just doing a sell stop below that first 15-minute candle, riding it down, buy stop above the, trailing your stop above these 15-minute candles. That was a solid 24 pointer and in a pretty short span of time. So nice 15-minute play right off the open. We had a divergence in the tick early on, meaning we had a low tick on the nicey tick that did not line up with low price. So, well, let me rephrase that. It did for about 30 seconds, and then we broke lows. And so that's what creates the divergence. And when you have a low tick early on that lines up with low price, and then you break it 30 seconds later, you don't want to be, now you have a divergence, you don't want to be buying up low ticks, because what happens is you end up making a low tick for 20, 30 seconds, and then you make a new low immediately. So not a good time to be trying to pick a bottom. And that's another reason why having some sort of simple approach to buying the dip, such as buying a gap up at lows, or buying off of a hammer, just some sort of approach to be able to get in when you get that pullback. Otherwise, you're sitting there just trying to catch a falling knife. And it might work out once or twice, but if you don't have a sound approach to picking that entry or placing the order, then you can get burned and just kind of be pumping in all your money on the very start of the move down, thinking, oh, here's my pullback. I'm going to put a little in. Oh, it went lower. I'm going to put more in. Okay, it went lower. I'm going to put it all in. And you've only moved, a percent off highs versus having a specific entry that you're looking for, such as some kind of hammer, a trend line, a gap up at lows, to give you a more repeatable buying process. So we had a tick divergence. Don't want to be just throwing orders out there at lows, but a nice solid 15-minute breakdown. The breadth and advanced decline line weren't super bearish this morning. We were like at 4 and 5 to 1 through most of the morning, negative 4 to 1 negative, and so not a huge surprise to see a turnaround. If it was like 10 or 12 negative to 1, okay, that's a situation where you're going to see sustained selling throughout the day. If it was 10 to 1 positive, you're probably going to be in a situation where it's a gap and go day, and it's going to run all the way into the close. The last thing I want to talk about is adjusting anchor points. So last week we had a retracement long and a retracement short drawn up. So now we can delete both of these because neither of them traded or held, and we can use that same high and bring it down to the new low. And so looking at the SPY, be watching this 468 level to see if we get some sort of pause here, and it might be worth putting on a short. Now, that being said, when the candle like today is so big, like the range is so big, sometimes we just end up with a bit of a consolidation in the couple days to follow. So no need to you know panic and load the boat short, but I will be using that as my reference point as a potential rollover to take us down and kind of make maybe a triple bottom down here at the 50% long, because we have not touched the negative 23 yet. And so when in none of these 50%, I mean, if you draw the 50% like this, it broke, retested the larger one, and if you draw the next one like that, even if you use this low point to highs, breaking the 61.8, the pattern has been to make it down to the 50%. So you can do a little of both, as far as you can add to a long position, and then you can hedge that long position by buying puts and capitalize on the move down as well. So lots of opportunities to make money. You don't have to overcomplicate it, and it's nice to have that long-term position chugging along. And if you can just kind of muster up the courage to buy that dip by having a simple strategy that you're looking for, or entry that you're looking for to buy the dip, then you can do quite well. The very last thing that I'll leave you with is if you're taking some sort of speculative play or something like a Tesla or a Bitcoin that has gone up a lot, taking off a little or really taking off enough to be comfortable and riding out the rest is a really good approach. So it's a little bit late here to be thinking about should I sell my Bitcoin or my crypto or whatever you have. But if you're in some sort of speculative play and it's gone up a whole bunch, it's okay to sell some to put you in a comfortable position, and then leaving you what's left to ride it out. And whether it, ends up going higher or lower, you're not super concerned because you've already cashed out enough or some to be, to live comfortably. So just, keep that in mind. Um, if you have a speculative play, putting it all in there, watching it go up, and then watching it come right back down, where you're, the same as where you started. It's not a very enjoyable feeling. So if you have something that has gone berserk with the 10x, 20x, 100x, 1000x, something that you don't typically see, maybe you see once or twice in a lifetime, okay to take some off the table to give you the ability to ride out the rest and not be stressing about it. So if you have questions, you can drop them in the comments below. We'll be doing a live trading session tomorrow. You can check that out at eminimind.com/VIP. Thanks, and we'll talk to you all soon.